We're now going to look at withholding taxes. And withholding taxes is a section which is only applicable basically to non-residents. For the most part, we get dividends tax is also sometimes considered a withholding tax, but we ignore that for now. Withholding taxes are usually only applicable to non-residents. So let me quickly explain to you what a withholding tax is. I want you to understand that withholding taxes exist because of practical difficulties that we experience in South Africa with non-residents. Now, there's a number of withholding taxes around non-residents. A lot of it is excluded from the syllabus. If I just quickly take you just to the next slide, there's a lot of these sections which are excluded from your syllabus. Right. Dividends tax will be in a separate study unit. So you basically only have these two, withholding taxes on interest and withholding taxes on immovable property, that you have to worry about. The reason why these ones have been excluded from the syllabus, Saika said that the principle around them is very similar to what it is for when you earn interest. So they say it's pointless for us to just test the same thing over and over again. Okay, so that's the idea behind it. They work in a lot of the similar way. Just for now, to make it a little bit easier, I'm going to talk about this foreign entertainers and sports persons, just the principle. Okay, so I want you to understand what a withholding tax is. So I'm not talking about the actual rules here, just so you understand. So, right, let's talk about Beyonce. Beyonce performed in South Africa not too long ago. Right, so let's say she earned 10 million rands from that performance. Is this from a South African source? The answer is yes, right? Because we look at the situation and at the place where the services were performed. She performed in South Africa, so the source is South Africa. So that means that that 10 million rands for her must be gross income. Now, if it's gross income in South Africa, it means there will be taxes payable on it. So how do we pay taxes in South Africa? As a taxpayer, you either need to be an employee, okay, then there's some taxes being collected. But apart from that, that's just a type of prepaid tax. How does taxes get paid? What is the process? You need to complete a tax return. So you need to go and complete a tax return. Well, I'm going to start here. Register as taxpayer. Right, as a taxpayer, then complete your tax return after figuring out how to do it, and then pay the money across. Now, I ask you, think about this practically. Do you think that Beyonce, she performs, and then she flies back to America? Do you think that SARS is going to have any luck to say to her, hey, please, you need to register as a taxpayer, complete a tax return, and pay your taxes? What are the chances of that working? And I'm not just using Beyonce, but there's thousands of people, millions of people, hundreds of thousands of people coming to South Africa from countries all over the world. How would you practically do this? It can't work. Can you see? So then we have a situation where we say, legally, in terms of our laws, Beyonce, you need to pay tax, but now we can't get you to pay. So what they've done is they created withholding taxes. And what the withholding taxes is it says, Beyonce, who paid you? Right? Let's just say it was big concerts, just for the sake of arguments. So big concerts paid Beyonce the 10 million rands. The withholding tax is they will go to big concerts and they'll say, okay, big concert, the withholding tax is 15%. So 10 million times 15% is 1.5 million rands. Big concerts, when you pay Beyonce, you owe her 10 million rands, but what you are going to do is you are going to pay her, you're going to do this with the 10 million. 8.5 million rands will go to Beyonce, and 1.5 million rands will go to SARS. So you say to Beyonce, yes, I owe you 10 million. Unfortunately, 1.5 million of that is tax. So you only get 8.5 million rands, and we pay the 1.5 million rands to SARS. And that is a withholding tax. Because now, if Beyonce we don't have to worry about telling her to do a tax return because we've already collected tax. Now you might say, guys, 15%, that's a lot less than what some of the taxes are. Sure it is, But that is just how it flies, I suppose. Right, because it's practically much better, and it would discourage a lot of people if you charge them 45% tax to come here. Right, it might make it unaffordable for the people also to pay them, because they'll still want to get out what they need. So this is a withholding tax. Now how you'll see how the Act has been written in the majority of the time is that 1.5 million rands there is a final tax. Right, the only exception to that is section 35A, which we'll look at it separate. Now, I want you to understand, guys, withholding tax is not income tax. It is its own separate tax. So, when we are going to do questions, I'm already just pointing this out to you because I want you to keep it in your head when you're looking at this. When you're going to do questions, if this is your script, you open it up. On page 1, on the left-hand side, I would do my withholding taxes, because the withholding taxes is usually a much shorter calculation, and on the right-hand side, I will do my normal tax. Okay, because you're still going to have to show the implications of it. So even though it's a final tax, the way in which they've written it, that it's a final tax, is that there's gross income and then an exemption, which you'll see. So again, guys, here, very important, you must show the calculation of withholding taxes separately from gross income. It forms part of tax payable and not part of taxable income. So what I'm trying to show you is that you need to do this. So you will do a calculation here. Right, normal tax, we will go gross income, exempt income, deductions, right? You will then calculate taxable income. From that, you will calculate tax per the tax tables. You will have rebates which you deduct. Right? That gives you your net normal tax. Added to that will be your withholding tax here. And this gives you your total tax that you have to pay to SARS for the year. Then from that, we will deduct our prepaid taxes. The amounts we've already paid, and this gives us our tax liability. So this is all things that you've already stated in the past and which we'll see in a lot more detail. I just want to show you where it fits in. For now, very important, withholding tax, normal tax are shown separately. Okay, so as I've mentioned to you guys, the two that you will be studying is withholding taxes on interest earned, which you can find in sections 50A, capital A, to section 50, capital H, and withholding taxes on the sale of immovable property in section 35A. Interest, guys, very, very popular. So, withholding tax on interest. So again now, I want you to understand. Let's actually start here. What is the source if someone pays interest to a non-resident? Remember, we're looking at non-residents. So the non-resident is the person receiving the interest. When is that amount of interest that the non-resident receives from a South African source? Section 92B told us, remember, if it's paid by a South African resident or if the funds were used in South Africa. So I'm just trying to remind you here, just quickly. Mr. A is the non-resident. He gives 100,000 rands loan to Mr. X, a resident. Mr. X pays interest paid of 10,000 rands. So guys, what is important when we are doing Mr. A, the non-resident, that interest there is interest received. Mr. A is receiving it, right, of 10,000 rands. So that's just important. I'm just trying to remind you, we're looking at the non-resident who is receiving income. So we determine the source by looking at Mr. X here and saying, was it paid by a South African resident? In this case, yes. So that's why it's from a South African source. Okay, so the withholding tax is calculated at 15%. It can be on a lower rate if the commissioner agrees. A couple of just important things you'll see is all references to the Act. Section 50B2 says the interest is deemed to have been paid at the earlier of the date on which the interest is paid or when it becomes due and payable. The withholding tax is a final tax. Right, 50C and E go together. A non-resident who receives the interest payment is liable for withholding tax. Right? The person who is paying the non-resident must withhold the withholding tax and pay it to SARS. Okay, so understand what this means. In this example, Mr. X pays Mr. A. Mr. X, the South African resident, the person who is paying, will say the withholding tax is 10,000 times 15%, so 1,500 rands. Mr. A will pay this across to SARS. But if for some reason Mr. A doesn't, he messes up and he doesn't. Sorry, Mr. X. Sorry guys, Mr. X, the person who's paying. Mr. X will pay it to SARS. If for some reason Mr. X, the resident, does not, then Mr. A must still do it because Mr. A is liable. Think about it like this. Who is taking the knock here? Mr. X, how much is this going to cost him the interest? Just 10,000. How much is Mr. A going to get of that 10,000? 8,500. Because 1,500, so there's the total, 1,500 goes to SARS, and 8,500 goes to Mr. A. So who takes the knock? Mr. A. So who's liable? Mr. A. That's the way of thinking about it. So if we have to do this calculation now, already I just want you to see. Withholding tax, normal tax. Right, this is for the non-resident. So it will be interest, 10,000 times 15% is 1,500. So that's our withholding tax. Under our normal tax, you will say interest received. How much, guys? 8.5, 1.5. How much? Always the amount, remember, before taxes. That's the Witwatersrand Association of Racing Clubs case. Always the amount before taxes. So 10,000 rands. So I want you to see so far what we've done. This is our withholding tax calculation. We've done 1,500. Normal tax calculation, we've included the interest. Okay, so you'll see the reason why I'm doing it in a second. Because I'm just skipping, I know I'm skipping this section, but just for now. Because in terms of section 10.1h, they tell you that if interest is earned by a non-resident, it will be exempt. So I'm just trying to show you for now just quickly how this section works. Section 10.1h, 10,000 will be exempt. So what is the net effect? Normal tax, null. Withholding tax, 1,500. So can you see we're only paying withholding taxes? That is why they call it a final tax. Okay, so this calculation I did here, guys, about withholding tax, that's almost as simple as it is. So we're just continuing talking about those withholding taxes now. We're still talking about it, right? It must be paid to SARS by the end of the month following the month on which the interest was paid to the non-resident. So if you pay the interest on the 15th of March, next month, April, end of April, 30 April. Okay. Now, when do we not pay withholding taxes? So when is it exempt? Guys, this over here, these two bullet points are super important. When do we not pay withholding tax? The first one is if that interest is paid by, so remember the person who is paying it, paid by the government or by a South African bank. So, Mr. A, non-resident, Absa Bank. Mr. A has a deposit of 100,000 rands with Absa Bank. So Absa Bank pays interest to Mr. A of 10,000 rands. Right, if we do our 2 pages, this is what will happen. withholding tax, normal tax. Interest, there's no withholding tax because it's an SA bank who is paying it, so there's nothing. Normal tax, you've received interest, 10,000 rands. Section 10(1)(h), 10,000 rands. So I want you to see it's possible that there can be no taxes paid. Okay, so that's the first exemption. If it's paid by a government, SA bank, or a listed debt. A listed debt is if a company on the JSE puts a debt up on there, and like a debenture, for example. Right. Also important, Section 50D3. Guys, Section 50D2 is excluded from your syllabus. Section 50D3 gives us more exemptions from withholding tax. And this is a very interesting one, and I want you to pay attention here. There will be no withholding tax if the non-resident was physically present in South Africa for more than 183 days. Right, 183 days is a half a year, so 6 months. In the 12 months preceding the interest payment. Now, I just used an example here where I said 15 March is when the interest was paid. Right, you count back 15 March from whatever date that was. So, 15 March, if this was 2010, to 15, it was received on 2011, 15 March 2010, just to give you an example. Okay, so you count not last tax year, just 12 months back. So, if that person was in South Africa more than 183 days, it is exempt from withholding tax. There's no withholding tax. Or if the interest is connected to a permanent establishment of the non-resident in South Africa. So if the person has a business in South Africa and it relates to that, then there's no withholding tax. Okay, very important, hold on to that, because our next section builds or uses that principle. So in the next section, I want you to see, we are now looking at our income tax exemptions. So if I take you to this screen that I've been doing here, we've been looking at this withholding tax. We are now looking at this normal tax. So this exemption I keep showing you, we're now talking about that exemption. Okay, so section 10(1)(h) is a specific section that only applies to non-residents. It says, this is how it starts. It says, if a non-resident earns interest from South African source, it is exempt. So our starting point is always that it is exempt like that. Okay, now it gets interesting. However, it will not be exempt if, first, if the interest was paid in the form of an annuity. This is something that we saw also for section 10(1)(k), the dividend exemption, if it's paid in the form of an annuity. Okay. Section 10(2) tells us, right, just be aware of it, but more important, these two. It will not be exempt if the non-resident was physically present in South Africa for more than 183 days in the 12 months preceding it, or if it's a permanent establishment. So guys, I want you to see, if you compare to section 50D3, it's the same situation. So section 50D says it will be exempt from withholding tax if those things apply, but section 10(1)(h) says it will not be exempt from income tax if it applies. So what does that mean? Okay, so I want you to just quickly here see. Non-resident receives interest of 10,000 from SA source. A, assume the non-resident has never been to South Africa. B, assume non-resident was physically present in SA for more than 183 days in preceding 12 months. Okay, so I'm just trying to trigger that situation. Okay, so first situation, where the non-resident has never been to South Africa. Let's try and fill it in. Right, so here's A. So let's fill it in, guys. So I just want to show you how simple it is. So we saw withholding taxes on interest. Withholding taxes on interest, there must be withholding tax calculated on interest at 15%. Unless it was paid by the bank, government, or illicit debt, or if the person was in South Africa more than 183 days, or was a permanent establishment. In this case, guys, it's not the bank or the government. Okay, we just now take it from a normal person. I don't want that exemption. I want to the exemption I'm trying to test and explain to you is this exemption about the more than 183 days situation. Okay, so first one is a person has never been in South Africa. So this is what will happen. Withholding tax, interest, 10,000 times 15%, 1,500. Normal income, normal tax implications. You have gross income, so normal tax. You have gross income, the interest of 10,000 rands. And then I'm reminding you, section 10(1)(h) just says, if a non-resident receives interest, it's exempt, unless this applies, but that does not apply. So section 10(1)(h) applies, and it is exempt. Okay, so what's the net effect? The net effect is that this person paid withholding tax of 1,500 only. All right, now look at what happens in B. So in B, the person was physically present in South Africa for more than 183 days. Right, so let's go up to withholding tax. So it says, there must be withholding tax unless the person was in South Africa for more than 183 days. So what does that mean? Withholding tax. So interest here. There's no withholding tax as person in SA more than 183 days. So nothing. Okay. There's still gross income. Why? Because it's from a South African source. 10,000 rands. What do we then know? Section 10(1)(h) says, Section 10(1)(h) says, it is exempt, but it will not be exempt if the person is in South Africa for more than 183 days. So Section 10(1)(h), not applicable, more than 183 days. So there we go. So just up to there, I just want you to see this principle before I confuse the matter. Right, can you see what will happen then? Then the effect is basically that you pay income tax and not normal tax. So what is the principle behind? Why is it written like this? Remember I said to you the issue is that it's very hard to recover money from a person. But if a person is in South Africa for such long periods of time, it becomes a lot easier. So that is why they basically go, if a person is in South Africa for a lot of time, we want them to pay income tax. If he's not in South Africa a lot of time, we want them to pay withholding tax. That's how the Act has been written. Can you see how clever it's been? So that they can complement each other. Now, all I want you to just see, this is not a perfect picture here, because remember, at the beginning of this lecture, I said to you, non-residents qualify for all the same exemptions and deductions that residents do, but they have some extra ones. So what do we know here at the bottom? There is an interest exemption in section 10(1)(i). You remember if you're younger or older than 65. Right. So the section 10(1)(i), let's say this person is older than 65, so it's limited to 34,500, and then you'll include it. I just don't want to put this in from the start, so this one you can now see there's a null effect as well, which is fine because if a South African resident earned 10,000, they also wanted it to be null. So that's kind of the reason why it works out like that. If this person obviously earned hundreds of thousands of rands in interest, then there would be income tax implication. But this is how withholding taxes on interest work. So guys, I've given you some steps to follow here. It's exactly what we just went through, and please use that when you are working for your lecture examples.